China's $900 billion funding gap. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article from Yahoo Finance discussing China's $900 billion funding gap and how it's providing a clue on stimulus. Because you've got to realize the economic effect, the economic interventions that are going to occur in China is going to have an effect and influence on the economy here in Australia. We're very closely tied to China. Many people actually consider the Australian dollar a proxy for the Chinese economy. Now, it's a completely additional discussion to even contemplate if that is a good thing, and the fact that how we've allowed how our political leaders on both sides have allowed us to get in this mess. But that's where we are right now. And then couple that with all of the trade tensions that are being fueled, particularly by Chinese-controlled media and propaganda pieces, which frankly are probably just tabloids for the masses over there. Well, we need to keep an eye on everything. So, eyes are on China's central bank for any signal of potential monetary easing as a $900 billion funding shortage rises concerns over tightening liquidity. The first clue may come Monday, when the People's Bank of China is expected to at least offset more than 600 billion yuan, 91 billion, of policy loans coming due this month. The funds, offered by the authorities a year ago via the medium-term lending facility, are just about 10% of the total amount local banks need to repay debt and buy government bonds by the end of 2020. While a meaningful net injection could be a signal that Beijing is committed to ensuring ample cash supply, a withdrawal may stoke fears of tighter monetary policy as the economy recovers from the pandemic. China is among the first countries in the world to consider reversing emergency stimulus measures deployed to support markets in the wake of the coronavirus outbreak. Here's a look at the funding pressures banks are faced with. Demand for cash will surge in the coming weeks as banks will need to repay more debt and buy new issued government bonds. A combined 1.2 trillion yuan in MLF funds is due in November and December, or roughly a third of this year's total. On top of that, lenders are set to repay at least 3.7 trillion yuan of short-term interbank debt and use another 1 trillion yuan to buy sovereign bonds by the end of 2020. But officials' recent comments have sparked funding concerns. Last week, PBOC Deputy Governor Louis Guingang said existing easing measures was a matter of time and necessary, remarks that helped send China's sovereign yield to a one-year high. The rhetoric came as recent data suggests the nation's economic recovery has been on track. A gauge of the manufacturing sector expanded for the 8th straight month, and credit growth remained stable despite a seasonal dip on October. The PBOC's comment struck a hawkish tone, suggesting money supply will be tightened, said Jing Zhopeng, an economist at Australia and New Zealand banking group. Any net injection less than 200 billion yuan on Monday won't be enough to soothe nerves on tight liquidity, he added. We see the 10-year government bond yield more likely to rise in the fourth quarter. Concerns about tighter liquidity have already driven banks to demand a higher yield when lending to each other. The interest rate on one-year negotiable certificates of deposit issued by AAA-rated banks has climbed to the highest since June 2019. The overnight repurchase rate also jumped to the most elevated since January on Thursday, providing further evidence of the thirst for liquidity. The PBOC on Friday responded by adding 160 billion yuan on a net basis into the financial system via 7-day repurchase agreements, the biggest injection since September 22. It looks like every central bank is doing the same thing, isn't it? It really does. So, commercial banks. The biggest buyer of Chinese government bonds now have less idle cash to invest in the fixed income market, and some of them even need to shed their holdings of the securities for funding. Worries over cash supply have already led to a sell-off in sovereign bonds with short tenors, which are more sensitive to shifts in liquidity conditions. This has helped narrow the gap between the 1- and 10-year yields to near the smallest since September 2019. That's bad news for bond bulls. The yield on benchmark 10-year sovereign bonds has risen about 8 basis points so far in November. That came after the notes just posted the longest stretch of monthly declines since 2007 in October, making them worst performance in Asia this year. So there we have it, everyone. What do you think is going to occur? And let's jump here and have a look at just some of these graphs. We can see banks face mounting MLF maturities in November and December. I mean, look at that. 600 billion in November and December. Here's the yield on one-year government bonds has risen to a 2-year high. We can have banks are paying higher interest when they're borrowing from their peers. So there we have it, everyone. What do you think is going to happen? And how will this manifest in the global economy? Also, what effect do you think this will have on the Australian economy? We'll have to wait and see. As always, thank you for watching. Like, share, and subscribe to the channel. Let me know your thoughts and opinions on the comments below. If you're a fan and want to support the content I create here, there are a few ways you can. You can join us on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you in the next episode.